Thank you for watching our series on Offer and Compromise with WatchGuard Tax Services. This video is on Datus to Collectibility Offer and Compromise. Your first question may be, what is a Datus to Collectibility Offer and Compromise? A Datus to Collectibility Offer and Compromise is a settlement of a taxpayer's tax liabilities for less than the full amount owed. If the IRS determines that the taxpayer can full pay the liability over the life of the collection statutes with disposable income and/or assets, they generally won't accept this offer. Datus to collectibility may be proven when the taxpayer's assets and income are less than the full amount of the tax liability and over the life of the collection statutes. Your next questions may be like, how do we do this? When do we start? And what are the qualifications? This type of offer is used when the taxpayer is not disagreeing with the accuracy of the liability and feel they are unable to pay the liability. Of course, you would need to prove this to the IRS. To prove a taxpayer's hardship, they will need to submit current financial information, including a Form 433A OIC for individuals, to the IRS. This form will explain the taxpayer's financial ability to pay the liability or not. The IRS will review your Form 433A OIC along with your supporting documentation and decide or negotiate if settlements is warranted for your outstanding liability. The process could be very difficult due to the possibility of the IRS rejecting your request. Lastly, you may want to know if there's anything else that you need to know if you're going to do this. When submitting the offer and compromise, there is an application fee. There are exceptions to this fee if you meet low-income guidelines. Along with application fee, there may be an initial payment you'll need to make based on the payment option you select. The offer can be paid in a lump sum cash offer or periodic payment offer. If the offer is accepted by the IRS, then the taxpayer has agreed to comply with the IRS tax laws. If a refund is due, the IRS may keep it if it falls into the calendar year in which the IRS accepts the offer. The IRS can default the OIC if the taxpayer does not follow the terms of the offer. One of the requirements is that the taxpayer timely files and pays taxes for the next 5 years after the OIC is accepted. If the IRS rejects the OIC, there will be a letter sent explaining why it was rejected and how to appeal. This appeal must be completed within 30 days from the date of the letter. Thank you for watching this video. Please like, subscribe, and follow to learn more about tax representation. WatchGuard Tax Services. Welcome to the solution.